the higher the leverage, the more the amplification. The faster, if you did all that, the Bitcoin went up 0% a year. It's not terrible. You don't get a lot of good amplification, right? So if Bitcoin goes up 50% a year, right, that's more amplification. So the rate of growth of Bitcoin, the ARR of Bitcoin, plus the leverage, plus the cost of capital, all those are primary factors that drive the amplification. Then as a rule of thumb, we kind of calculated that, assuming Bitcoin appreciates 30% a year and we get 30% leverage, then we should be able to get a 3x BTC factor, or we can accumulate 3 times more Bitcoin per share over a 10-year time frame.
As Bitcoin hovers around the $107,863.76 mark, a bold vision from MicroStrategy's Michael Saylor is reigniting debate across the financial world. Michael Saylor, executive chairman of MicroStrategy, remains one of Bitcoin's most influential advocates, and his latest outlook ties Bitcoin's long-term growth directly to the evolution of digital credit. As Bitcoin, BTC, struggles to reclaim the $107,863.76 level, analysts at Bitwise predict the asset could grow at 30% annually over the next decade, echoing Saylor's own bold vision first outlined in 2025. This forecast may seem ambitious, but it reflects a growing belief that Bitcoin's unique structure, institutional adoption, and macroeconomic tailwinds position it as a cornerstone of future global finance. Saylor explains that the next major opportunity lies in creating digital credit systems backed by Bitcoin. Companies can hold BTC as digital capital and issue credit instruments against it, controlling volatility, yield, and risk through structured collateralization. Beyond simply holding Bitcoin like an ETF, Saylor highlights how firms can enhance returns through credit amplification, using instruments like preferred stock to leverage their holdings responsibly. He notes that with Bitcoin appreciating 30% yearly and applying 30% leverage, companies could potentially achieve a 3x Bitcoin factor over 10 years. For Saylor, the most sustainable approach to such growth lies in perpetual, publicly issued instruments that expand Bitcoin exposure without increasing systemic risk. If you found Michael Saylor's vision for Bitcoin's future as fascinating as we did, drop your thoughts in the comments, share this with fellow crypto enthusiasts, and don't forget to subscribe for more insights into the evolving world of digital finance.
And the opportunity with digital credit is you create a company, you hold Bitcoin, that's digital capital, you start to issue credit instruments on top of the capital, and you can decide how much risk do you want to strip away. Is it a BTC rating of 2, which is 2 times over collateralized, or is it 10? Right? 2 is less risk stripped away, 10 is more risk stripped away. Strip away the amount of risk you want, strip away the amount of volatility. The smaller the instrument compared to the overall collateral pool, the less the volatility. And then there are a lot of terms and conditions that you can put in the instrument that would constrain the volatility. So you decide how much volatility and risk you want to strip away. You decide how much yield you want to give it. You decide whether you want it to be in pounds or Canadian or euros or yen or whatever, and then you distill out, you extrude the yield and the pure, boost over the risk-free rate. So if you think about the value of the equity over and above net asset value. If the company did nothing, if it just bought Bitcoin and held Bitcoin forever, it starts to look like an ETF. Probably it trades around NAV. The way that a company generates a premium to NAV is primarily through credit amplification. So if a company can generate, say, 30% leverage, then it's going to create an amplifier because you can see systemically, I issue $1 billion of a preferred stock paying 10%. I buy $1 billion of Bitcoin, right? If I own $1 billion of Bitcoin already and I was able to do that trade, I'd have $2 billion of Bitcoin, no additional common stock outstanding, so you end up with 50% leverage on that. So you start to generate amplification. Now, we have models to calculate how accretive that is. How does that contribute to Bitcoin per share? And it turns out that it's more accretive, but this won't come as a surprise. It's more accretive if the cost of capital falls. For example, raising the 10 billion at 5% instead of 10% is more accretive, right? Raising it at 1%. Imagine borrowing $1 billion at 1% and buying Bitcoin that returns 55%. You're capturing 54% spread, right? So the spread that you're capturing is a function of your cost of capital. So the lower the cost of capital, the more the amplification. The higher the leverage, the more the amplification. The faster, if you did all that, the Bitcoin went up 0% a year. It's not terrible. You don't get a lot of good amplification, right? So if Bitcoin goes up 50% a year, right, that's more amplification. So the rate of growth of Bitcoin, the AR of Bitcoin, plus the leverage, plus the cost of capital, all those are primary factors that drive the amplification. That as a rule of thumb, we kind of calculated that, assuming Bitcoin appreciates 30% a year and we get 30% leverage, then we should be able to get a 3x BTC factor, or we can accumulate 3 times more Bitcoin per share over a 10-year time frame. So you could imagine an MNAV floor of 3, right? Makes sense, or, whether you do that in percentage or you do that in a factor. And, for when you're evaluating a company, the question is, how high can they take the leverage? How much is it going to cost them? There's second order effects like credit risk, right? So I'm describing perpetual instrument never comes due. There is no credit risk there. But if you were achieving that leverage with a 6-month loan, yeah, right? You can go on a exchange and you can actually crank up the leverage to 3 or 4 or 5, but the duration is instant, right? You get forced liquidated overnight. When we're managing the business, we're constructing credit amplification in the most intelligent way. And of course, in my opinion, the least risky, most intelligent way to create credit amplification is through publicly issued preferred stocks that are perpetual,
Right.
right? For the obvious reason, you never refinance them. The principal doesn't come due. And so the risk on the principal is de minimis.
As Bitcoin once again captures global attention amid its volatile climb, MicroStrategy's Michael Saylor is redefining how investors view the world's leading cryptocurrency, not just as digital gold, but as the foundation for an entirely new era of digital credit and financial innovation. Michael Saylor notes that Bitcoin functions as a form of digital capital, a long-duration, high-performance, and highly volatile asset class best understood over decades. He compares it to a 20-year investment instrument, emphasizing that Bitcoin's true power lies in its endurance and appreciation potential. With historical volatility between 45% and 70% and average annual growth near 50%, Saylor calls Bitcoin high-energy capital. Yet, he envisions the next evolution of Bitcoin finance through digital credit instruments, such as Treasury Preferred Notes or Stretch, which offer fixed yields, like 10% dividends, over short periods while remaining heavily over-collateralized by Bitcoin. By over-collateralizing assets 5x or 10x, volatility and downside risks can be significantly reduced, even if Bitcoin experiences sharp drawdowns. Saylor likens this innovation to how banks use preferred and mezzanine equity to generate leverage and enhance returns. In his view, these Bitcoin-backed credit systems could achieve high price-to-book ratios, mirroring traditional banking models, but powered by decentralized digital assets. As Bitcoin continues to dominate the crypto landscape, this transformation may signal the next stage of its evolution, from a speculative asset to a structured, yield-bearing foundation for the digital financial era. Let's get back to the interview.
I would stop there and I would say MNAV is just price to book value. Okay, well-run banks trade at a price to book north of 2. But what is Microsoft's price to book value?
Right.
It's like 20,
Sure.
10. So a lot of companies trade at a price to book 5, 6, 7, 8, 10, right? Like they have very productive capital, right? They have huge leverage on it,
Right.
right? So an MNAV of 3 is just a price to book of 3.
Right.
So, how do you get there? It's simple to figure out how you get there. For example, if you have $10 billion of Bitcoin and you sell $10 billion worth of Stride, STRD, you would have a leverage factor of 50%, no credit risk, right? So, yeah, you'd sell another 5 billion of Stride, right? If you can sell it, right? This all comes down to not should you, can you,
Can you? Yeah.
right? Not should you, and if you do, you will get there, right? If in that particular case, it all comes down to what kind of credit can you issue, and under what terms, and how rapidly.
So at 50% leverage with no credit risk, I mean, then there's a 5 times, right?
Yeah, you could get to an NAV of 5, or you could be priced to book of 5.
Right.
But ask yourself the question: how do banks get to a price to book more than 1? Leverage,
Right.
right? But why do preferred stocks exist at all? So banks can generate leverage on the common,
Yeah.
right? And so everything I'm describing is not, we didn't invent that.
Yeah.
There's 5,000 banks in the country right now. There were 25,000 banks 100 years ago. Thousands and thousands of banks and all sorts of finance companies. They generate intelligent leverage using various tiers of equity capital: mezzanine equity, preferred equity, senior preferred, junior preferred, little bit of debt, and then they got common equity. And the question is, so why? I mean, why does your favorite bank have to issue anything at all? They're the bank, and the answer is because they're actually creating equity on the. They're generating leverage on the common. That's all. I mean, J.P. Morgan, all these, they could basically pay off all their debt if they wanted, but the point is they're trying to create leverage on the common to give the common stock value. So the only difference is they're not really strategic about they're not trying to make their credit instruments the best in the world and brag about it and make them homogeneous and transparent. The equivalent of kerosene in the Bitcoin industry is a treasury preferred credit instrument like Stretch. So on one side, you have digital capital, Bitcoin, and Bitcoin is a long duration, volatile, high energy, high performance source of capital. Long duration, think of it in terms of like 240 months, like 20 years. You should, if you want to get the optimal performance, you can hold it for 20 years. Like it's a 10 to 20 year type investment.
Right.
High volatility, right now it's about 45 vol. Implied vol, it's been 50, it's been 60, it's been 70 vol. And high performance, appreciating 50% a year.
Right.
So that's the raw commodity. What happens if I strip away the volatility, strip away the risk, strip away or compress the duration, translate it to a given currency and extract the yield? Right? That's what a treasury credit instrument or treasury preferred is. So that's what Stretch is. The idea is you build something that's got 1 month. Like I'm going to give you 10% dividend yield for 1 month. Like the duration is 1.
Yeah.
The yield is 10%. The currency base is US dollars.
Right.
The spread is like if the risk-free rate is 400 basis points, and that's like a 6%, 600 basis point credit spread. I've extracted a 600 basis point spread for the next month in US dollars.
Right.
Maybe I 5x over collateralize it. Maybe I 10x if raw Bitcoin is like 1 to 1. It's like if I have $1 of Bitcoin, I have $1 of Bitcoin. If Bitcoin trades down 50%, I've lost half my money.
Right.
But if I 10x over collateralize something, I have $10 of Bitcoin. I have $1 of Stretch. If Bitcoin trades down 50%, I still got $1 of Stretch. If Bitcoin trades down 90%, I still have $1 of Stretch. The statistical odds of Bitcoin trading down 90% are like point something, right? It's a small percentage. So
The message to investors is unmistakable. Bitcoin is evolving from a volatile asset into a foundational pillar of modern finance. With growing institutional adoption, innovative credit structures, and long-term accumulation strategies, Bitcoin is positioning itself as more than just a store of value. It's becoming productive digital capital. As over-collateralized instruments and yield-bearing models emerge, the asset's role within global markets continues to expand, bridging traditional finance with decentralized innovation. Holding Bitcoin is no longer merely a speculative play. It's a strategic stance in a financial system shifting toward transparency, scarcity, and digital strength. The future of wealth preservation and growth may well be written in Bitcoin's code. Do you think Bitcoin's transformation into a yield-bearing financial asset will redefine the future of global finance? If you believe in Bitcoin's long-term power as much as we do, share your thoughts in the comments, spread this insight with fellow investors, and don't forget to subscribe for more in-depth updates on the future of digital finance.